Good morning and welcome to Weekly Insights with John Plassard. You hear a lot of talk about hard landing, soft landing, no landing, and balance sheet recession. But what exactly do these barbaric terms mean as the year 2024 gets off to a flying start? Firstly, cyclical recession. Historically, this would mean a moderate contraction of the economy, followed by a return to growth in late 2024 or early 2025. Inflation will hold steady for some time before returning to target, with interest rate remaining high for longer before central banks opt to cut rates. In terms of investment, inflation-linked bonds preferred as inflation remains sticky, although nominal bonds will benefit as rates fall. Then the soft landing. A soft landing scenario would involve a slightly below-trend slowdown in the major economies with no major shock disrupting markets. The decision to keep interest rates higher for longer will bring inflation to a level with which central banks are comfortable. This would then allow them to pivot and cut interest rate, easing the pressure on indebted households and businesses. In terms of investment, less defensive and mid-cap names likely to outperform the market. Then there is the balance sheet recession. Historically, this would be characterized by a deep and prolonged slowdown in developed and emerging economies. A severe default cycle will set in corporate markets, and weaker sovereign states would also come under pressure. As balance sheet recession would lead to a widespread reduction in corporate and household spending, central banks would respond by sharply cutting interest rate, while inflation would also fall sharply. In terms of investment, safe haven currencies and gold will be interesting. Finally, no landing. In a no-landing scenario, US economic growth will remain resilient, while Europe's current slowdown will be reversed. Core inflation will remain stable at 1 or 2 percentage points above central bank's target, encouraging policymakers to keep interest rates at current levels. In terms of investment, refinancing rates could be challenging for higher leverage names across bonds and senior secured loans. If you wish to have much more details about all those scenarios, please don't hesitate to ask us. Otherwise, have a fantastic week, stay safe, and keep on winning.